Plenty of significant fundamental events this week. Got US CPI on Tuesday, the Biden-G meeting on Wednesday, preceded by significant Chinese economic data. You got retail sales, earnings from retail heavyweights, and then, of course, the November 17 deadline. See if we can avoid a government shutdown. This is after Moody's mood turned sour with that U.S. credit outlook cut from stable to negative. It's about time, though, from a sentiment standpoint, that we take a look at the one and only S&P 500 or US 500 on IG's trading app and platform to take a look at exactly where traders are positioning themselves going into these events. So let's go ahead and start off with IG client sentiment. Week on week, inner circles for the start of last week, outer circle for the start of this week, 63% majority sell, going into heavy sell territory at 66%. So bracing for losses when it comes to indices. We will take a look at how exactly they got there when we get to the chart. Let's go in and take a look at COT speculators. The report for last week delayed, but from the week before that, we can see that in the middle, and the week before that, in the middle as well. No change, even though there was an increase, a larger increase in shorts than there were in longs, but essentially staying close to the middle. So how exactly did they get there? Here, we're going to go ahead and we're going to plot it onto the chart. So this is a candlestick chart. Price corresponds to the right axis. What we're doing is we're plotting sentiment on top of it, and it's going to correspond to the left axis. You got the red dotted line, which is the 50-50. Whenever you see the dotted line go above, which we're not seeing in this case, but whenever you see a dotted line go above, it means the majority buy. Whenever the dotted line is below it, blue or green is below it, it means that they're majority short because the left axis is percent long. So if we see, for example, the green dotted line in the past over here, it was back in September and October, it was 40%. That means that they're 40% long, which means majority sell 60%. And what you'll notice here is that, first off, the two of them are very close to each other. That's a very rare occurrence. We've covered quite a number of products, euro, pound, yen, gold, oil, even the US Tech 100, and we saw a much bigger distance between the two of them. There were times where they might overlap, but usually there was a bigger distance, and sometimes, like we saw with USD JPY, for example, on opposite ends. One is extreme sell, the other is extreme buy. But in this case, opting to stay very, very close to each other and not too far off from the middle, with the exception, of course, is what we saw here and what we saw back at around October of this year. Again, this is the daily time frame. We are going to zoom out to the weekly to get a better idea, but essentially the story has been one of they were majority short prior to this move lower, so they were positioned for that one properly. But afterwards, what we saw is that when price went lower, shorts got out, longs were initiating, and then afterwards you saw that this move over here was really the big surprise, that we saw client sentiment really go further into majority sell territory, reach heavy sell, and since then trying to average their way out a little bit, but then afterwards we got that sizable boost. So in this case, from a couple weeks back, by the way, what essentially led for these price gains was at the FOMC, but seemed to be a bit of a slight tweak, noting tighter financial conditions that might be doing its work for them. And then you had the Treasury funding announcement that was lighter than anticipated. And then afterwards you had generally worsening economic data out of the U.S., primarily U.S. non-farm payrolls on Friday. And then you had this big boost, and all of that essentially, you saw longs getting out. And those that were trapped at higher levels looking for an excuse to get out, they saw this as a chance to get out. You saw shorts initiate, and as a result, we got ourselves into heavy sell territory. I'm going to go ahead, though, and zoom out to the weekly time frame. So now we're looking at a weekly chart. This is from start of the year up until now, and then we're going to go ahead and we're going to put sentiment onto it. And very interesting to note, once again, pretty much very close to each other. I know there is this brief moment over here. We had the SVB, the regional banking crisis in the U.S., Silicon Valley Bank, so on, and then you had risk appetite go south. IG clients, the blue dotted line, timed that one quite well in the sense that they shifted. Shorts got out, longs initiated, and actually briefly went majority buy, and then afterwards they went up. But you see COT speculators also. It was a very similar approach throughout this period of time. Where exactly was the surprise, though? Because they were anticipating negative events. I want to say not just traders, fund managers as well. They were also bracing themselves for negative risk events. They were focused more, for example, towards income instead of taking on sizable risk. And the real surprise was over not just the resilience, but afterwards this move up over here, which a large part of it, I've spoken about this before, had to do with, if you look at the week-on-week investment flows and things like that, had a lot to do with investors going in and trying to position themselves for any gains on the AI front. So really trying to go in. I know a lot of you out there will go, oh, this is the S&P 500. You're including the Magnificent Seven. If you look at the S&P 493, minus the big seven, then afterwards the story is much less rosy year to date. So even if there are gains, much less than when you include those seven. But long story short, we're looking at the S&P 500 overall. That's what traders are trading. And you saw that over here. that in this brief moment over here, you have price moving up and down. You did see shorts try and average their way out, and then came this big gain over here, and you saw them go towards heavy sell territory. And then once again, in some of these moves, trying to average their way out, get up over here, throughout this period of time, not going towards extreme sell territory. So a bit cautious about going towards extreme sell, unlike COT speculators who were actually on the wrong side of this. I know a lot of times we look at this and we go, oh, COT, they got it right, or they usually position for the momentum. In this case, they were actually positioning opposite for quite some time, and then finally started to try and unwind their way out. Even when we saw a pullback, they didn't actually necessarily go with it much. They actually tried to unwind before reaching towards the middle. And this is where we finally see some divergence between the two of them, these gains recently, and we see that COT speculators, according to, again, this is weeks back, we're seeing them sort of on hold with a slight sell, in the sense that you saw in the circles it was 50-50. That's because we round to the 50, and slightly beneath that. So very, very, very slight sell bias. Now, the thing to note about the S&P 500, and the difference between this and what we see for some of the other products that we covered in our sentiment study, is that a lot of times traders, investors, large and small, will use it to protect against their portfolio. So for example, those of you notice that we have a physical shares offering. If you go and you buy and you're investing for the long term, we have stock CFDs where you can go long and short with leverage. We also have the physical shares offering. So those that are, you can't short those. So with the physical shares, you're long on your portfolio. And when you want to try and protect against it, the way that some will do it is they'll go and they'll initiate shorts when it comes to some of the key indices that better tracks their portfolio. So if they're very heavy on tech, they might go in short with the US Tech 100 or NASDAQ 100. If they're a bit more balanced, you might see them short when it comes, for example, to the S&P 500. So sometimes you have to look at this and think to yourself, okay, fine, yes, they might be classified as traders, but there might be a bit of hedging going on where they're trying to protect, especially if they, when they see the gains and they're a bit worried and they want to protect more and more of their portfolio, you'll actually see them turn more towards the sell side. So that might be a part of what's happening in this case when it comes to the S&P 500 that you may not see as much with some of the other products that we covered in this sentiment study report. And I want to go ahead and pull up IG's trading platform, just to let you guys know. This is the US 500 or S&P 500. And just to let you guys know that if you do want to check client sentiment, we're just going to click on over here. This is client sentiment over here. We have a few other items as well. And that's the chart right over here. So that's about it from our end. I want to thank you guys so much for watching. Good luck out there. And as always, happy take.